Okay. Testing. All right, I think we're good now. Gosh, you'd think I'd done this before. Forgot to plug in the mic. Okay. The sound quality good to everybody? Hey, Okaje. Yes, I did shift a day this week because I am out of town tomorrow going skiing. So, got to get it done early this week. Knock it out on Tuesday, and then I'll be probably not on the slopes tomorrow, but Thursday for sure. There is a discussion coming. Keith Rudman got a stock pick. So if you're new to the stream, I pick a stock every week that I invest in on my public YouTube portfolio series. And we're going to be doing a little bit of discounted future free cash flow, intrinsic value calculation on what I think is a really interesting company with a really high yield, which I don't normally go after, but this company in particular, I think looks really good. So, okay, let's go ahead and get started. Nice. Okay. Okaje, new old ticker to keep an eye on, IBM. Okay, I'll have to check that out. Maybe after, let's look at it actually after we finish our usual program here. Okay, where to begin? Okay. Okay, it can be incredibly tempting to go after companies that have very high dividend yields. But the problem is that the dividend is really a smokescreen. What's not important is the amount of the dividend. What's important is the free cash flow. And as long as the dividend is covered by the free cash flow, then the company could be a very good investment. So as my initial screener, sometimes I like to go through and filter by high dividend yield companies, and then set a secondary filter for projected revenue growth over the next 5 years. That's exactly what I've done here. I've just got the company, the dividend yield, the industry that it's in, projected revenue growth, and then the country that it's in. Excuse me. So in this case, I wanted to make sure that I'm picking companies that have projected growth over the next 5 years, because a lot of times the reason a dividend on a company is incredibly high is because the company's share price has been dropping down. And in most cases, the company has been holding its dividend where it's at. And then as the stock price falls, the dividend yield goes up. But a lot of times the stock price is falling for a reason, and then the dividend is soon to follow. So one of the most important things I like to look at is the projected free cash flow. So the company that I'm looking at today is the Western Union Company. So let's pull this company up really quick. And as what's typical, if I go to the 5-year page, this company has been dropping in value over the last 5 years by about 60%. And if I go to their dividend page, and let's scroll down to the graph, we can see that they had been raising their dividends in 2017. And then after pandemic in 2021, they've maintained their dividend, but their share price has been dropping, and therefore the yield has been going up. So the number one thing that I look at on a company like this, before I get into my discounted free cash flow analysis, is I go to the financials, I like to go to the cash flow statement and look at how are they using their cash flow. So over the last 5 years, this company has been dropping in operating cash flow, which is a red flag. Now, just because something's a red flag doesn't mean it's going to be a deal breaker for us, but we do need to look into why this company has been dropping in operating cash flow. So in 2025, they brought $543 million in from operations. In terms of investing, they had a little bit of capital expenditures. They purchased intangibles. They invested in securities and a few other investing activities. They had $230 million go out in terms of investing. And if we scroll down finally, to the financing cash flow, we can see that they issued some debt and repaid some debt, but on the net, they actually paid back debt. They repurchased $234 million worth of common stock, and then they paid out $309 million in dividend. So I was not expecting to see this at all when I saw that the company was yielding over 10% on dividend alone. And then I go to the cash flow statement and I see that they've bought back they've spent nearly as much money buying back shares as they have paying dividends. And then I look back in time at their dividends and their dividend payments. The amount of money that they've been putting into the dividends has been dropping drastically. If I go back to, what year is this? 2021. This company had to pay $381 million for their dividend. They have not dropped their dividend in the last 5 years. We just looked at that graph, and yet the company has had to put in less and less, $81 million less to pay the same dividend. And that's because they've been aggressively buying back shares. Now, this, in my mind, is a green flag. The company has been going down in value, and yet management has really ramped up their share buybacks. A lot of times this is a signal that management believes the company is undervalued. So not only are they returning tons of cash to shareholders through their dividend, they're also buying back shares while the company's stock is very low. So in terms of future prospects, if this company is able to turn things around and the market likes what they see, and we see the share price going up and we see the company in a position to maybe start raising the dividend, they're going to need a lot less money to support the same dividend as they had before. And since there are fewer shares outstanding, each share owned today will be worth more and more. So let's look at how much they've actually bought back their shares. So if I go to the income statement, go to their shares outstanding, going back to, really going back 10 years, they've consistently bought back 2 to 5% of all of their outstanding shares. And so in, what year is this again? This is 2016. They had nearly 500 million shares outstanding. And if we go to today, 328 million. So this company is what I like to call a cannibal company. They are aggressively buying back shares. 8% of their total shares they bought back last year. And on top of that, they are having a huge dividend. So, okay, I talked a little bit about free cash flow before and whether or not the company's free cash flow can sustain this dividend. And really, when I'm valuing a company, I don't use the dividend at all. The dividend it does a couple things. It's a signal when the dividend yield is very high. It's a signal that the company could be undervalued. And it sets a psychological floor to the stock, because if the share price continues to drop down and the company is a strong company and they are continuing to be profitable, as investors see that dividend yield getting up into the double digits, just like it did for me, it gets people's attention. So in my mind, as long as the company itself is performing well, that high dividend yield it sets a floor, a psychological floor to the stock price. So, okay. So we talked about the signals, but let's get down to the nitty gritty. What is the discounted future free cash flow for this company? The valuation based on their free cash flow. So if I go to my spreadsheet here, this is where I built an automated discounted free cash flow valuation spreadsheet where all I have to do is type in the ticker. The spreadsheet will pull all of the relevant information off of stockanalysis.com. On the next tab, I format it into neat rows and columns. On the next tab, the calculations are performed. And then finally, all of this is spit out on my dashboard right here. If you're interested in downloading my spreadsheet, you can tweak it and make it your own. It is available for free if you go look in the description. So WU, Western Union. I just realized I never really talked about what exactly the Western Union company does. So let me quickly jump back and read what this company does. If you want to take a look at a better dividend stock, you should look at VAR Energy. Okay, I'll check it out after I get done analyzing this company for sure. I'll check it out. We'll see if it's better based on the discounted free cash flow. Okay, about the Western Union Company, it provides money movement and payment services in the United States and internationally. It operates through two segments, consumer money transfer and consumer services. The consumer money transfer segment facilitates money transfers for international cross-border and intra-country transfers, primarily through a network of retail agents, owned locations, etc. The consumer services segment offers bill pay services, money order, media network services, retail, foreign exchange, prepaid cards, etc. So they are in the financials sector. The industry that they are in is the credit services. Okay. Let's go to the spreadsheet. There are, has a 15% dividend. You mean by high percent dividend. Gotcha. So higher in terms of dividend. And yeah, 15% is crazy. I'm definitely down to look it out. What is the actual ticker for VAR Energy? Is it just VAR? Looks like your A has a weird little hat on it. Anyway, so for this spreadsheet, there are a few assumptions that I have to make. Number one, future revenue. I've got 3 cells where I'm projecting the future revenue of the company. I calculate the future cash flows by first projecting the revenue. There's always very clean analyst projections for revenue. It's not always the most straightforward to find profitability metrics going out into the future, especially for free cash flow. So I look at the analyst projections for future margin for the next 5 years. I use past performance and a combination. Well, I use a lesser version of the analyst 5-year projection for my 6 through 10 year projection. And then for the perpetual growth rate in revenue, I use a value roughly equal to inflation. For the free cash flow margin, for my profitability, I look at a combination of past performance and analyst projections. So for revenue, years 1 through 5, one way I can get that information is on stockanalysis.com. They will aggregate analyst projections. So if I scroll down a bit, I can see for revenue growth, the high, average, and low projections right here. And so I simply copy that, put it into my spreadsheet right here. Okay. They do not give projections for year 5, only the first 4 years. So I will fill in my own projection and I will make it just a bit more conservative in year 5 than in year 4. So that's where we're going. So year 2030 is the Brian projection for high, medium, and low, but these are all of the analyst projections for revenue growth. Okay. For years 1 through 5, for this cell right here, for my own projection, so the analyst projections get calculated right here. This is where I use my own projection for year 1 through 5. It'll go right here. Currently, I have negative 1% in there, and we will get to that. For years 6 through 10, I have 2% revenue growth, and for my perpetual growth rate, I have 2%. I'll talk a little bit about these 2 cells in a moment, but first, let's look at the free cash flow margin. For my initial free cash flow margin, I primarily use past performance, but I make a few adjustments to the free cash flow margin. I will adjust it based on their R&D spending, their CapEx spending, their acquisitions, and stock-based compensation. So all of these things go into the formula for free cash flow margin, but they are always done 100%. They're always applied 100% or 0% on stockanalysis.com, where they do the typical free cash flow calculation. So for instance, R&D is always found on the income statement and it goes against a company's income. And then when you go to the cash flow statement, let me just quickly run through this. On the cash flow statement, when you're calculating this operating cash flow, you always start with the net income and then you adjust that net income by the non-cash expenses. So this net income will obviously be reduced right here. So I don't know where they put R&D in this segment. It could be on cost of revenue, or it could be in the operating expenses rather. It's most likely in the operating expenses. So R&D will be baked in here, which will be reducing the net income. And then on the cash flow statement, you're starting with net income and you're adding these back in. So for companies that are spending on R&D for a specific goal that will increase their future free cash flow, I like to count at least a portion of that R&D towards free cash flow. I like to give a little bit of credit because generally I defined free cash flow as money that is either being returned directly to shareholders through dividends or share buybacks, or money spent that's going to contribute to increasing future free cash flows. So some R&D is going to be maintenance. Like they have to spend that R&D every year just to maintain their current customer base. So for instance, Apple has to release a cell phone every single year or whatever the frequency is. And there's a certain amount of R&D spending that's going to go into that, just like maintaining that churn of new product. So for some companies, I give them R&D credit, for others not. In this case, they don't have any R&D spending. So a little bit of a tangent there, 0 on R&D. For CapEx, they spend very little on capital expenditures. It's the same thing. Capital expenditures is counted typically 100% against free cash flow. But if they're expanding in a way that is going to be bringing more free cash flow, I'll give them credit. In this case, it appears to be such a small amount, it's not going to move the needle. So 0% in there. For acquisitions, same thing. So in this case, acquisitions are typically not counted against free cash flow. However, if a company is constantly acquiring other companies to build their top line revenue, but it's not really increasing their profitability and they don't have a synergistic effect with the companies that they're acquiring, then I'll count the acquisitions against, because I don't see it as bringing true value to shareholders. And then finally, stock-based compensation, which this company has 0% stock-based compensation. So really I'm explaining all this, but it's not actually affecting this calculation. But just for your reference, I count 95% of stock-based compensation against free cash flow. Okay, so we've ended up with our historical average free cash flow margin of 14%. And so that is my baseline. I'm putting 14% in here. And so based on this initial set of assumptions where they have their historical average free cash flow margin going forward, they are losing 1% revenue per year for the next 5 years. And then they're going to turn it around and just build 2% revenue going forward into eternity. Based on that set of assumptions, this company has a 99% upside, assuming I want to make 8.35% per year. That is the final assumption on my spreadsheet. So if I was going to be happy based on the discounted free cash flow, if I was happy with making 8.35% per year, then I should be willing to buy this company at $18.64 per share. However, it's currently trading at $9.36. So there is a 100% upside, or you could say a 100% margin of safety on top of my 8.35% per year. So based on that set of assumptions, the Western Union company is incredibly undervalued. And in terms of their dividend and their share buyback. So in the meantime, while they're undervalued, assuming they are in fact going to turn things around and start making just a little bit of revenue every year after 5 years, their dividend and their share buybacks are covered by their free cash flow, their operating cash flow. So $543 million minus about $40 million for CapEx. So in 2025, they had roughly $500 million in operating cash flow. And if we go down to their repurchase of common stock and dividends paid, roughly $500 million spent. So in my mind, this company, if they're able to turn things around, they can cover their current dividend. All they would have to do is scale back on their stock repurchases. So I'm going to say this dividend is relatively safe, but again, there's a lot baked into that. There is the assumption that this company is not going to continue to fall. So this is the next step where I want to read some analyst reports about the company's future prospects. And my favorite, my favorite place to do that is the Morningstar Equity Analyst Report. I love this analyst report. They do a great job of breaking everything down. They give a fair value estimate. They put it at 17. My initial estimate was 1864. So they are in the neighborhood of what I had calculated. They have a narrow moat, small value company, medium uncertainty, and a standard capital allocation. They currently rate this company 5 stars in terms of being undervalued. So incredibly undervalued. Western Union's fourth quarter results weren't impressive as industry headwinds continued to pressure the top line and revenue was weaker than expected. Why it matters, Western Union continues to see pressure on its domestic outbound business, given a more adverse political environment, with revenue down 5% year over year in the quarter. The North American region was down 13%. While we appreciate the headwinds the company faces, we'd like to see more progress in improving digital channel results. Digital adjusted revenues and transactions were up 6 and 13% in the quarter. We'd like to see the company make progress in reducing this spread. Okay, the bottom line, we maintain our $17 fair value estimate for the narrow moat company and see the shares as undervalued. Okay. So let's see. Let me go down a bit. Okay. So business strategy and outlook. Western Union's performance in recent years has been weak, which we think has played into the idea that the company is being disrupted by newer players. But we think the pressures the company has faced historically will ease a bit going forward. We continue to believe Western Union has a narrow moat based on its sizable scale advantage, but with limited long-term growth prospects, the amount of the value the moat will increase. Sorry, I had a stroke. The amount of value the moat will create could be questioned. Additionally, the company faces some political headwinds as well. Okay, so they're seeing some issues. However, they believe Western Union has obviously a narrow moat, and they think that the pressures will ease. So let me scroll a bit further down. Okay, hold on. Okay, the Western Union appears to be recovering its overall position. However, the growth that the company is seeing in digital transfers has not led to the strong overall growth historically. We don't expect this situation to change. Okay, so that's kind of where they spell it out. So it's not like this company is, I don't know, expected to have explosive growth going forward, but as we saw with our projections, we don't need explosive growth out of this company for it to be incredibly undervalued. It just needs to sort of maintain its current foothold, and with Morningstar giving this company a narrow moat, that means that it has some pricing power and that it should be able to maintain or improve its margins over time. In fact, Morningstar analyst report, if we scroll down to the very bottom, they have a table where they actually put numbers to their projections, which is incredibly helpful because I'm trying to build a spreadsheet. So revenue growth over the last 3 years, they've lost 6% per year, but going forward, the 5-year growth is expected to be 1% growth per year. So Morningstar Equity Analyst Report is saying they're expected to lose 3% in 2025, and then they're expected to gain about 2% per year starting in 2026 and going to 2029. So Morningstar is saying that they are not going to be losing revenue for the full 5 years. In fact, they're going to turn it around. So that is where I decided to use a bit more of a conservative estimation for the next 5 years. I'm going to assume they're actually going to decrease for the full 5 years, and then they're only going to turn around to 2% going forward in years 6 through 10. So basically what I'm seeing here is a more conservative estimation than what Morningstar puts, and yet I'm still seeing a huge potential upside. Now, the next exercise I like to do is I like to put in the assumptions that create the current fair value today. So I like to invert my thinking. Instead of trying to come up with the most accurate assumptions, what does the market, let me just put in what the market is expecting from this company. So first, let me start by decreasing the free cash flow margin. If I drop their free cash flow margin down to 10% going forward, now we see, for my projection, we see a 25% upside. So the market is saying that this company is not going to be near as profitable as they have been historically. In fact, they're going to lose more than 1% for the next 5 years. They're going to lose 2%. And then maybe for years 6 through 10, they're only going to make 1%. And maybe for the perpetual growth rate, maybe 1%. Okay. Based on that set of assumptions, now the company is just right at that fair value. So if this set of assumptions is true, then we are going to make our 8.35% per year. That's what this is telling me when I invert how I'm trying to calculate the value of this company. Now, based on the 1% for years 6 through 10 and the 1% perpetual growth rate. But then instead of using this figure for years 1 through 5, if I instead use the spread of analyst expectations for that year 1 through 5 revenue, we see still a pretty favorable spread of intrinsic values where the upper end is 63% upside and the lowest end is losing 17%. So essentially, I have to be comfortable that the company is going to exceed this set of assumptions. If they do worse than this set of assumptions, that is where I lose money on my investment. I need to be confident that they're going to exceed this. And the number one thing I want to attack here is how confident am I that they can achieve better profitability than 10%. So if I go back to the Morningstar report, not only do they project revenue, they also do several different margin projections. So first of all, for operating margin, in the year 2024, they had 17.2% operating margin. Morningstar is projecting an average of 18.6 for the next 5 years. So increasing their most recent margin. For EBITDA, that's earnings before interest, taxes, depreciation, and amortization. For EBITDA margin, It was 21.8 in 2024. They're projecting, they don't calculate the average for some reason, but it looks to be about the same. For adjusted EBITDA, 21.8, they're calculating 22. For net margin, it was 22. So net margin is quite a bit different, but I typically don't pay attention to, that would also be profit margin. I typically don't pay attention to profit margin as much as the other margins. And most of all, I like to look at the free cash flow margin the most. Now, in terms of the way that Morningstar calculates free cash flow, I don't know exactly how they do it. They probably do it a little bit different than I do. So I don't put so much stock in the actual numbers themselves, more in the trend. So in 2024, they show free cash flow margin of 9%, and then going forward, they show an average of 14%. So once again, in my mind, that tells me that the professional analysts are projecting that Western Union is going to be increasing its margins going forward in the next 5 years, possibly in line with the average performance. Morningstar equity analysts put it at 14. If I put it at 14, we see a massive upside, even with this reduced revenue growth projection. So that still puts me at a 62% upside. So being undervalued in terms of free cash flow, while simultaneously returning millions of dollars to investors through share buybacks and dividends, where the dividend yield is over 10%. And then if we couple that with the share buyback yield, it gives me an overall yield of over 14%. So let's look at that really quick on stockanalysis.com. If we go to the ratios page and scroll down to the very bottom, we see a free cash flow yield. First of all, let me point this out. Free cash flow yield of 17% is very impressive. Typically, you'll see a free cash flow margin. If you see 10%, it's great. Anywhere from 8 to 10 would be a great free cash flow yield. This free cash flow yield is 17%, is really, really strong. Dividend yield, 10%. Payout ratio, this means they're paying out 61% of their profits in dividends. And then buyback / dilution yield, 4% for a total shareholder return in terms of dividend yield plus buyback yield of 14%. So that is huge. Another thing I like to look at is the return on capital invested. So if a company is reinvesting in itself, I like to see a high historical return on invested capital. That just shows that the company's investments are paying off. Now, in this case, Western Union has not been reinvesting in itself so much. They've more so been returning their cash to shareholders. So if I look at CapEx and purchase of intangibles, this is about 150 million. And then I compare that to the 540 million that they're returning to investors through just buybacks and dividends. That's where the majority of their cash is going. So in this case, this is a mature cash flow machine company that is just shoveling cash back to investors in the form of dividends and buybacks. So this is the company that I'm investing in this week on my public YouTube portfolio series. We invest in a different company every week, $200. We also invest in one company that we're already holding, $50. So that makes for a total of $250 per week that we're investing into our public YouTube portfolio and tracking the performance. So I'm going to pull it up right here. So we are at $9,200 on the portfolio. Sorry, that is not the total amount. Let me it should be like 9,600, but it's not showing me the total amount for some reason. Anyway, 9,200 plus $400 in gains. We are currently up 11.32%. If I view the benchmarks, we compare ourselves to the S&P 500 over the course of the portfolio all time. This portfolio is only about a year and 3 months old, so we're not, we haven't been doing this very long yet, but this is a value-minded portfolio. So we're looking to outperform the S&P 500 in the long term. Now, we're currently up just a couple percent over the S&P 500 all time. So we are pretty much in line currently. We invest in a different company every week. So currently we have over 50 companies. So it's not like we are holding with the S&P 500 while just having a couple companies. No, we've got 52 positions to be precise. So And I say I invest in a different company every week. Sometimes I double down just on an existing company. So we've also exited some positions. So at the current time, we have 52 positions. Okay, let's go to the portfolio. So okay, sorry, I have some comments. I signed up for your newsletter. Are you on Substack? I feel like your analysis, I like your analysis, but need to sign off. Thanks. I am not on Substack. I hope to see you again. Thanks for tuning in to the stream. And there was a company you said you want me to check out. I think Okage put the ticker in. I'll check it out. But yeah, I appreciate you tuning in. And yeah, maybe I should consider a Substack. Okay, Hokage says, do you think AGI and HG is overvalued right now? I locked in some gains on both AGI and PLAB. Also, rumors are going around that PayPal acquisition by Stripe. Interesting. $159 billion valuation. Wait, you're saying that Stripe... Hold on, let me pull it up. Am I crazy? So, you're saying, I figured I had it backwards. You're saying that PayPal is going to acquire Stripe, right? No, you're right. You're saying Stripe has a $159 billion valuation? Is that true? That's crazy. I didn't realize Stripe was so big. That's not publicly traded yet, is it? Stripe? Am I crazy? No, it's not, is it? Stripe is planning to acquire PayPal. That is wild. Are you saying that Stripe has a valuation of 159 billion? Or are you saying it would be nice if they acquired PayPal for 159 billion? Because that would mean that my holding would triple in value. Yeah, I thought it was private. Okay. Interesting. That could be, Hokage, that could be a good topic for a video. Okay. Where was I? Ah, yes. So which company are we reinvesting in this week? So let's bring up an old company that we have quite the history with. Hims. Okay, so we bought Hims on this portfolio. It was one of the first companies we bought. It popped off. Thankfully, we took some profit. We should have took profit sooner, but we didn't. We took some profit, and now it has dropped by 53%. So now the question is this company undervalued right now? Or is this the beginning of the end? That's the question. Let's put it in. Hims. Okay, past free cash flow margin, 1%. This is the first thing I'm going to look at. Now, if we look at the historical free cash flow margin, it was quite negative initially, and it has been trending more positive as the company's grown, gotten bigger. Let's just, as a baseline, let's give them credit for 10% of R&D. Now, in 2025, they have spent a lot on CapEx. So this is typically a signal that the company is investing in its future growth. So this number right here, 76%, this is a proxy for percent growth and percent maintenance. I am looking at their overall CapEx and I'm comparing that to their depreciation. And I'm using depreciation as a proxy for maintenance spending. So in this case, maintenance is about 24% of their total CapEx. So the assumption is that they spent 76% on growth. So we're going to start with that. 75%. Okay. Now, that puts their average over the last few years. I'm going to put priority on these previous few years. The sum of these 3 years is 17%. Divided by 3, we'll call it 6%. So let's say they have a 6% free cash flow margin. Okay. And yeah, 95% against on stock-based compensation. We're going to give them credit for 6% margin. Now we need to look at what is their projected revenue growth. Forecast tab on stockanalysis.com. The analysts think that this company is going to be growing rapidly. So let's copy that. That's the average analyst. And we'll put this into the spreadsheet. Okay. So initially, so the average is, what is that? 64 divided by 5 is what? 15? No, 13. So it's roughly 13. We'll say 10% for years 6 through 10, and we'll say 3% for a perpetual growth rate. So this is, we'll make this our baseline set of assumptions. I just kind of threw it in there. So just to get an initial look, 20% undervalued. The spread is quite large, with the highest, most optimistic analysts give me a 135% upside. The lowest give me a 50% downside. So there is a huge, huge spread. Now, on the flip side, if I look at their past performance, now surely the company cannot continue to grow at 54% per year. But over the past 5 years, that has been their average revenue growth. So is it true that this company is slowing way down? Let's look at the Morningstar Equity Analyst Report. Let's see what Morningstar says. So Morningstar gives this company a very high uncertainty rating, no moat, standard capital allocation. So Morningstar does rate it slightly undervalued currently at 4 stars. The analysis is very up to date. This is as of February 24th. That's today they made this article. Hims and Hers delivered 28% revenue growth and 10% adjusted EBITDA margin during the fourth quarter, with both figures landing above the midpoint guidance. 2026 includes $2.8 billion revenue at the midpoint. So they were looking good in terms of their most recent quarterly report. Let's see. The bottom line, we lower our fair value estimate for no moat Hims to $23 after adjusting our assumptions to account for elevated costs related to geographic expansion, new therapy launches. Let's see. Shares sold off 65% in the last earnings and now trade at 4-star territory. That said, we see a lot of question marks on the name, including litigation with Novo Nordisk, potential regulatory changes to the compounding industry, and the success of new launches and new markets. Our very high uncertainty reflects these concerns. So this is the issue with Hims. When I'm doing a discounted free cash flow analysis, you put in garbage assumptions and you get garbage projections. And with a very high uncertainty, if I tweak these numbers a little bit in any direction, it can make for a huge difference in the valuation on this spreadsheet. So this is the problem with trying to evaluate a company like this. So let's scroll down though. Let's do the best we can. Okay. And this is why we stay very diversified, because there's a lot of uncertainty involved in investing in all companies. You never know what's going to happen in the future. So you invest in as many great companies that look great on paper, and then you see how they play out in real life. Okay. Revenue growth, 58% in 2025, and then 18, 13, 11, 9. So the 5-year compound annual growth rate, according to Morningstar, is actually 21%, which is huge. So now let's put in 21%. Oops. Okay. This now brings me up to a 71% upside. So, but again, there's a very high level of uncertainty. So if this company has issues, does have litigation, they end up losing millions and millions of dollars because of this lawsuit with GLP-1s, then there goes all of that revenue growth. In terms of profitability, in 2024, 4% operating margin, increasing up to 6% on average over the next 5 years. EBITDA, 5% in 2024, increasing up to 10% by the end of their 5-year projection. Net margin, 8.5%, about the same, 8%. Free cash flow margin to the firm, 5% in 2024, and then really not looking very hot. However, Morningstar is calculating free cash flow to the firm, free cash flow is looking pretty rough over the next 5 years. So lots of mixed results. In my mind, when I started looking into this company, I thought that maybe HIMS would be the one that I would want to double down on because they've just dropped by so much. But the problem is, I just find it so difficult to nail down the free cash flow margin. And if this swings down by just a couple percentage points, then it eats into this projection in a big way. And let me show you an example of that. So if I drop it just down to 4%, that eats up all of my projection. There goes all of it. So with the amount of uncertainty with this company, I think that I'm just going to leave it where it is. And I know this is a little bit boring, but I've been doubling down on Adobe the last 4 weeks, and I think I want to double down on Adobe one more time. So I've already gone over Adobe live on stream, so I'm not going to do it again. So now at this point, I want to look at stocks that you guys want me to check out. So, okay. Stripe is planning to do power. Okay, where were we? Didn't HIMS buy a big pharma company in the UK? Also, from what I've heard, Novo is almost certainly going to sue them. Yeah, they're going to sue them. There is a lot of uncertainty there. I just don't feel good putting more money into HIMS. It's a very, very, very small percentage of the portfolio, and so I'm just going to let it ride the way it is. I'm not going to reduce my holding at this point. I'm just going to leave it alone. There is potential upside there, so maybe it'll pan out, maybe it won't. So let's look at Very. Kajay says, so the 15% dividend company, that is what people wanted to see. So let's pull this one up. VAR Energy. Okay. Dividend says 7%. So maybe something changed recently. Let's go to the dividends tab. Their dividend has been kind of up and down. This is a relatively young company, isn't it? Yeah, it's a very young company. So at least they've only been public since July of 2023. They've gone up considerably in share price. In the last year, they've gone up 13%, but their dividend's only 7%. So I don't know what Keith was. I think it was Keith, right, that wanted me to look at this one? Oh, no. It was user. Sorry, I'm not going to try to say your name. It was user. VAR Energy, 15% dividend. Hokage. Oh, wait, no, please use the real ticker. It's wrong on the OTC. What is the real ticker? Did you say it in chat? Hokage says, apparently Vari has super low volume. There is a ticker called VAR. Oh, in the Oslo Stock Exchange. Okay, OSL VAR. Okay, let me do this right. All right, I could probably just type in VAR, right? Here it is. 14%. Okay, now we're on the same page. So this company, it is in USD. In order to, so I did tweak, I have a sample spreadsheet. So I'm not gonna be able to use my current spreadsheet because the way I do this, my equations change when it's a company like that, So I'm basically building this hyperlink, and for a company like that on a different exchange. Hold on, let me pull up my other spreadsheet. Let me see if I can do this really quick. And hopefully get it to work. Bear with me. Let me just get this pulled up really quick. Okay, I think this is it. Okay, so I think I have to type it in like this. So it would be OSL /VAR. Uh-oh. No. Yeah, it is OSL /VAR. So what is going wrong? Sorry, I may have to, this may have to be homework for me. Yeah, oops. Yeah, sorry. Sorry, man. I'm gonna have to tinker. I tinkered with this spreadsheet in the past to try to make it be able to analyze companies that are on other exchanges. I had it working before, but as you can see, something is not working. I'll have to get back to you on that one. But we can at least analyze the company. We don't have to use the spreadsheet. We can look at it in terms of its cash flow. So let's start with the income statement. So the first thing I like to look at is I compare the operating income to the interest expense to see how much is their debt affecting their bottom line. You know, the debt is a very small percentage right here, so that looks great. As I scroll down, I also like to look for asset write-downs, and I do see some asset write-downs, but nothing too crazy. Oh, and impairment of goodwill, but again, nothing too crazy there. And I'm just like looking at it as a percentage of its income, basically. Scrolling down a bit further, I like to look at the shares outstanding to see if they are buying back shares. This company is not. It's virtually flat. And then I like to look at their margins. So 85% is a pretty high gross margin, but I don't really know what this company does. What does this company do? Let's start with that. Independent upstream oil and gas company on the Norwegian continental shelf in Norway. It produces crude oil and natural gas liquids. The company was formerly known as, it changed its name. Okay. So margins, free cash flow margin looks pretty good recently. Margins seem solid to me. Next thing I like to look at is on the balance sheet. I like to see how much cash they have compared to their current long-term debt. So not bad. Not a ton of long-term debt. I mean, this is essentially covered by their income of a single year. So in terms of debt compared to their profit, it's very good ratio. I also like to check the percentage of goodwill and intangibles to their total assets. So if goodwill and intangibles are a high percentage of their total assets, I see that as a red flag. But in this case, they have mainly property, plant, and equipment. I also like to look at, where is it? Typically, they have retained earnings on here, but I am not seeing it. Anyway, not seeing retained earnings. They didn't put it on the income statement, do they? No, it should be on the balance sheet, but it's usually they put it down here at the bottom, but I'm not seeing it. So, okay, it looks really good so far. In terms of their cash flow, okay. Huge depreciation and amortization. I don't see any stock-based compensation, which is a green flag. So $4.6 billion in operating cash flow. They spent half of that, or over half of that, in CapEx. They acquire a little bit of acquisitions, some other investing activities. Their investing cash flow is negative $3 billion. They paid back some debt and they issued some debt, but on net, they've been increasing their debt the last few years. They have paid dividends and other financing activities. Okay, so in terms of their net cash flow, I mean, their net cash flow has been pretty much positive. They have positive free cash flow. So from what I'm seeing, it looks like they are covering their dividend just fine with their free cash flow. So, I mean, at first glance, this company looks pretty interesting. Free cash flow margin is pretty high. Let's look at their ratios. Price to book is a little bit up there. Price to free cash flow ratio, though, is very low. And return on invested capital is consistently in the teens the last 6 years. Free cash flow yield is 20%, very high right now. Dividend yield is obviously very high. The payout ratio looks high because they compare the profit to the dividend. But for a company like this, you don't compare the profit because their profit is reduced by a huge depreciation. And they don't show it on here, but their depreciation on the cash flow statement is $2.8 billion. So they really have $2.8 more billion in cash than what's actually shown on their profit. So anyway, this company looks interesting. I think I do want to put it in my discounted free cash flow calculator and see how it looks. There's only so much I can do just looking at the balance sheet, the income statement, the cash flow statement. I mean, but for what it's worth, I'm not seeing any crazy red flags. It looks like they are generating plenty of cash. Over the last 10 years, they have been growing their operating cash flow pretty consistently. Now, this company is going to be very much tied to commodity prices, the price of oil. So to some extent, their operating cash flow is not in their hands, that based on the price of oil. So that is something to keep in mind. Yeah, you can use the very ticker. Some calculations may be wrong if you want to use your model. I'll try it. I hate to even put it in because I don't trust what it's going to show. In fact, yeah, it doesn't even work on my primary spreadsheet. Very bad. Anyway, I'll make this my homework. I'll look into this. I'll try to tweak my international version of the spreadsheet to work with that ticker. Okay. Hokage, do you think there are some undervalued gold like AGI, silver, copper tickers? Tickers, good question. Something I need to look at. And Hokage is signing off. Hey, I appreciate you tuning in, buddy. I will see you next time. I think you had some other companies you wanted me to look at as well. You said, yeah, you mentioned AGI and HG. Are they overvalued now? I will look into those. You locked in some gains on HCI and PLAB. Also, rumors are, and then the PayPal stuff. I will look into that stuff. And again, man, I appreciate you tuning in as always. I'll catch you next time. Good night, buddy. Okay, in fact, let's just really quick. I am curious to look at HG. Let's look at HG really quick. Hamilton. Is this one that I was able to invest? I think it was. In the last 6 months, this company has done quite well. And let's go to our financials. HG. So yeah, this was one, unfortunately, that was not Hokage, if you're still there. Unfortunately, HG was not offered on M1. That's too bad. That was one that we looked at that we really liked. And it seems that it has done very well over the last 6 months and over the last year. It's too bad we were not able to invest on the public portfolio. But for my own investments, I will look into this company to see if I need to sell. Not on my public portfolio, but since it's not on the public portfolio, I won't continue to look at it on stream at least. Also IBM. Okay, yeah, I remember you saying IBM. Also, recent insider buying and the high executives are getting paid by the performance of the company. User, which company are you talking about for recent insider buying? That's always a green flag. In terms of PLAB is one that we invested in on the portfolio, and it has been doing very well. That one is in the small, right? Yes. Well, it's only up 13%. Oh, but I think that's since we rebalanced. Let's go to activity and see when we bought PLAB. So we bought PLAB on April 30th. We doubled down in September, and then we cut our position down a bit in January. So we initially bought it at $18.20. Oops. We doubled down. Dang it. Oh, we actually doubled down at $22. So it went up and we still bought more. I hate how it makes me type it in. Like, I wish I could just go back. And then we sold at 33. So yeah, it was 18. We went to 22. We doubled down anyway. And then we cut our position a bit at $33 per share. And it is currently at 38, 39. So man, we didn't cut it all the way, and maybe it's worth it to look into, you know, like Hokage said, is it now officially overvalued at this point? A great question, but I think that's a question for the next stream. It's been an hour. Typically don't like to stream much longer than an hour. Oh, okay. User, you're saying the insider buying is for VAR. Sorry, 2 years. And also, I don't know why my name is like this. Yeah, that's all right. You will just be known as User on the channel. Or, you know, you can tell me what your name is. You can tell me another name to go by if you want, if you're going to be regularly tuning in. Let me know how you'd like me to address you. But in any case, I appreciate you tuning in. Everybody else that was watching and not commenting, I appreciate y'all watching as well. Please hop in the comments next time and let me know what companies you want me to look at. And I would be happy to analyze a company live on stream, just a surface level discounted free cash flow analysis. And then if it looks very promising, then I will do my homework off stream and maybe feature that company in a video or the next week's stream. So as always, I appreciate all of you guys tuning in. User, Hokage, I'll catch y'all next time. And Keith, thank you for tuning in as well, Keith. Everybody else, have a good night. I streamed early this week. Today's Tuesday. Normally I stream Wednesdays at 7:30, but I am going on a ski trip tomorrow, so had to get my stream in early this week. Yeah. Catch you guys next time. Good night.